Personal finance practice problem using Excel. Investment and earnings and after-tax yield. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in one of two practice tabs as opposed to one of two example tabs. We're going to start here on the practice tab 1 and then move on over to the practice tab 2, remembering that the example tabs are in essence the answer keys. So we have the information on the left-hand side, going to populate that into the blue area on the right-hand side. We have an investment of $1,000, interest earned after 1 year is going to be $105. Now note, of course, when we're thinking about putting money into an investment account, we typically want to think about the interest rates or the rates of returns, usually on an annual basis, so that we can compare and contrast different rates of returns, even if we're thinking about different dollar amounts that we will be investing. You could, of course, be in the similar situation, but have the end result where you're saying, okay, I've earned so much on a particular investment after a particular time frame, and you want to compare those earnings, say, to other earnings you got on other investments or other earnings that other people have or potential investments into the future. To do that, you can't do it just with the dollar amount of the 105, for example, because I might have more initial investment in some other earnings. So then we can, of course, back into the interest rate. Now, when we get to the interest rate and calculate the rate of return, then we usually want to do that on an annual basis again. So you could get your rate of return on some period other than an annual basis, meaning you could do it for like 1 month. You could do it for 5 months. Whatever you earned in 5 months divided by the initial investment would give you the rate of return for that 5-month period, which would be fine if you're comparing that to other returns that you got for that same period. But if you're comparing to the industry or other investments, then the standard would generally be to get your rate of return into an annual type of basis so that you can then compare it, because that's kind of the standard that we typically look for when we're comparing different rates of return. So obviously, if we had our interest earnings, in this case, we're going to say interest, but it would be the same if you had other kind of earnings, gains and whatnot, whether realized or not on the stocks or bonds, if you're trying to figure out what your gains were on that, whatever your dividends or something like that, same kind of thing. We take, of course, what you received, in this case, interest, divided by the initial investment, which was going to be the $1,000. And then we're just simply going to say that's going to be our rate of return, which we'll call our annual percent yield, which is going to be equal to the 105 divided by the 1,000, making that a percent by going to the number group, percentifying it, adding a couple decimals. So we're at the 10.5. Let's put an underline under the 1,000, home tab, font group, underline. So we've got then the 10.5 on the return. So once again, you could do this division problem for any time frame that you want. So if you're looking at the rate of return you got over 5 months, or like I say, 2 years, 3 years, you can do that. And if you compare that to other investments that you have over that same time frame from your books, because you're looking at your own returns, then that you can do a comparison, like that kind of comparison over the same time frames. But and you can compare different amounts with different dollar amounts, because remember, I can't compare the 105 to what I earned on some other investment when I had an investment of $10,000 in that thing instead of $1,000 in here. I can compare over the same period the ratio of the return, which is the percent. So I could do that for periods other than a year, but then if I want to compare to other investments, which I could potentially put money into going forward, then the traditional method would be, or the traditional way these things are represented, is annually. So you'd want to basically look for the annual return and annualize your returns so that you can then compare what your performance has been compared to what you might be able to get in somewhere else. Okay, so let's go to the second practice tab number 2. This time we're looking at the after-tax yield. We talked about the fact that some types of investments, especially like interest in government bonds or something like that, might have a tax-free component to it. So we might then think, well, what if I was comparing then an investment where I have to pay taxes on it and another investment where I don't have to pay taxes? In other words, if I had two kind of investments where I'm going to be earning interest, a savings account, CD possibly, versus a bond versus a government bond where I don't have to pay interest, then how do I account for the fact that one has a taxable component and the other does not? Because if I have to pay taxes, that in essence lowers my return, my annual yield. So to do that, we would need to then have the marginal tax rate. Now that's going to be something that's going to be unique to you, or that's going to be your marginal tax rate, because remember, we have a progressive tax system. That means that the taxes go up as income goes up. So there's two ways that you could try to get a nice simple rate that you can work with. One is to use the average rate, or the effective rate, the average rate, which is not what you usually want to do, because that average rate is going to be lower than your top tax bracket because you're taking the average. But if you're doing something different, making a change, then you're making the change as of now on the margin, as economists say, and that means the impact is going to be at your highest tax bracket. So the highest tax bracket, we're going to say here, just for practice's problem's sake, is 35%. We're going to assume here that means that multiple tax brackets could be involved there, of course, but the highest one we're at, we're just going to say 35% for practice problems for it. So we're going to say, all right, then the taxable yield, we're going to say, and so obviously if I look at my two options, and if this one is tax-free, there is no tax impact on it because it's tax-free. So the return I get is 7%, no taxes involved. This one, if I'm trying to compare it, I have to say, well, yeah, I get an 8% return, which is higher than the tax-free return, but I also have to take into consideration the tax impact on it. Now, also just realize that usually the one that's going to be tax-free will usually be lower. You're going to get a lower return because the fact that it's tax-free means that the market usually is going to value it more, right? Because the market's going to take into consideration that fact. So usually if something's a tax-free return, it's going to be lower than the same kind of risk you would be taking on returns that would be taxable, because the market is going to take that into consideration. But with your individual portfolio, that's when you want to basically think about how this fits into your individual portfolio. And if you can get if your returns are significant, some of them tax-free and some of them taxable, possibly you can even lower the tax bracket that you're in by having spending cash or earning revenue on a significant part of your earnings that are tax-free, and some of your other earnings on the taxable component, which could, even lower the tax return possibly. So it's going to be something that you want to tie into your individual portfolio. But if we're just comparing these two, we're just going to say, all right, the taxable yield we'll say 8% over here. And then I'm going to take 1 minus the tax rate and colon. I'm going to do a subcalculation on this, which is just simply going to be in the inner column 1 minus the marginal tax rate, which is our highest tax rate that we're paying, which we're saying is 35 for the purposes of this problem. Let's make that a percent, go into the number group, percentifying it, font group, and underlining it, and that'll give us our total 1 minus the tax rate. Putting that into the outer column, this equals the 1 minus the 35%. Let's go ahead and percentify that cell by going to the number group, percentify. We're at the 65. Let's underline it, font group, and underline it. And this will give us then the after tax yield, IELD. My fingers always do that backwards. And then I got to make this a percent up top too. Let's go to number group, make that a percent. And then we can take then the 8% times the 65. Let's go ahead and number group percentify that, and we get the 5. Let's add a couple decimals, 5.2. Let's actually add an investment now, just so we can see that played out in action. So let's say we've got the $1,000 on, this is going to be the tax-free yield, which would obviously, I'm gonna format this as I go. Sorry, it's not pre-formatted for us here. We're gonna practice the formatting. We'll make it black and white on the title, and then I'm gonna just take the investment of the 1,000. That's gonna be the 1,000, and then we're gonna take the rate. If the tax-free rate was the 7% return, There it is, making that a percent, number group, percentifying it, font group, underlining it, and that's going to be our tax-free return. We'll call it, this is going to be equal to the 1,000 times the 7, and that is what it is, the 70. Nothing more we need to do. We're just going to go to the font group. Let's go ahead and put some borders around it. That's not the border. Here's the borders. Borders, and then we'll do the little blue thing. And then we've got, let's pick up the tax. See if I can put this over here maybe. This will be the taxable yield, after tax yield. And so I'm going to go to the paint, make it black and white again for that nice contrast that we have with our colors contrast. And then we're going to say this is going to be our investment. So I'll pick up the same starting point of the investment. Now we've got the yield, which is going to be the taxable yield, which is now 8%. So we get the more on the yield here. If we had a $1,000 investment, number group, percentifying that, font group, and underlining it, that would be the return before taxes. Return before taxes would be equal to the 1,000 times the 8, $80. But then we've got taxes, tax rate, let's say the marginal tax rate, because we're saying we just made this decision on the margin. So we're picking our highest tax bracket rate is 35%. The government's going to take from us. Font group and or number group, percentify, underline it, font group, and underline it. So that means we got taxes of equal to $80 times 35%, $28 in taxes, so that we then have the tax, so the after tax return is going to then be equal to the $80 minus the amount that we paid in taxes, or the $52. And so there we have it. And obviously, if I take then that 52, this 52 divided by the original investment, and make that number percentify groups, there's our 5.2%, and that would be our after-tax yield. We calculated up top. That might be a little bit more clear when we actually add the an investment to it. We can underline that, and we can do this. Now note, you can also calculate this. Let's just do this one more time, because we did this kind of the long way. If you're going to use a book problem or something, you could do the same calculation, and they might simplify it a couple different ways. So we might say, okay, well, if the investment was 1,000, then we could just say, of course, we did our calculation for after-tax yield up top, and we could just say, okay, then the after-tax yield calculation as we saw it up top is the 5.2, and go to the number group, percentify that, add a couple decimals, and that would be the taxable, what did I call it over here? We'll just call it the after-tax return. So clearly that would get us there quickly. So we're going to go we don't need any decimals. Let's underline this and make this a little larger. And then we'll make that blue. And one other way we can, just to see this calculation a couple different ways and practice our Excel here, we could then say, if we copy the same top portion, I'm going to make this black and white again. We can say, let's start at this top piece, the same, 1,000, taxable yield, 8%. We're going to say number group, percentify, font group, underline. That's going to give us our return before taxes, which would be the 1,000 times 8. And then you might pick this spot to kind of simplify your process and call this 1 minus the tax rate to get directly there, and that would be equal to 1 minus the 35% tax rate, making that a percent number group percentifying, getting us to the 65% font group underline, and that would then get us to, say, the 80 times the 65, 52, and that would be our after-tax return after taxes. And then, of course, we could calculate the after-tax yield, which would be the 52 divided by the original investment, making that a percent number group percentify. And then I'll put some fancy stuff around that. Let's do a quick spell check. Okay, so just note that if you work with different people, they'll do their calculations a little bit differently. And most people, once they get used to what they're doing, if you're talking to a finance person or something like that, or an accountant or CPA, they're probably going to, do their calculations quite quickly. And if you're looking at a book problem, they'll try to make their calculations as small as possible rather than as easily to understand as possible. So I would think this calculation is easiest to understand. And of course, this calculation where we don't even use a dollar amount is somewhat abstract, probably the most difficult to understand. And then you can get some variations. This is a common variant kind of difference between ease and a hybrid between the most easy way to understand it. So you might see any of these, again, depending on what world you're talking about, whether you're talking to a professional, whether you're doing a book problem, or whether you're trying to figure this out on your own.